Singapore has cut its forecast for growth this year to between 0 and 2% as it braces for more tariffs in the US and softening global trade. The revision is down from February's projection for growth of 1 to 3%. Early estimates also show the economy growing 3.8% in the first quarter. It missed analyst expectations for an expansion of more than 4%. There was weakness in manufacturing and some service sectors such as finance and insurance amid slowing external demand. Growth in the manufacturing sector moderated to 5%, supported by higher output. One observer says manufacturers that embrace sustainable and digital practices could find new areas for growth.
We believe those who have evolved their business model and evolve, especially leveraging technology and digitalization and connect themselves into the global ecosystem, could respond better, faster, and more agile manner to handle different situations, because it's changing by the day.
The Trade and Industry Ministry expects a significant weakening in external demand, which will impact sectors such as manufacturing, wholesale trade, and transportation clusters. Some observers warning it could dampen business and consumer spending. While various sectors are set to see headwinds, there are potential bright spots.
For example, if there's divergence, so if the rest of the world is being tariff very high, and then shipping comes to Singapore, for instance, with relatively Singapore is a lower cost economy, then there could be some trade diversion, but the impact is still not expected to be as big as the downside risk to the collapse in global demand.
Singapore's central bank is easing its monetary policy for the second time this year. That move coming amidst mounting concerns over the trade war brewing between the US and China. The Monetary Authority of Singapore will reduce the Singapore dollar's appreciation slightly. MAS also lowering its core inflation forecast to average between 0.5 and 1.5%. This was driven by lower than expected inflation in the first 2 months of this year. That's down from the 1 to 2% in January. Core inflation excludes accommodation and private transport. One economist says MAS could potentially let the Singapore dollar not appreciate.
Considering that Singapore's economic growth is set to weaken further in the second half of the year, and with Singapore's inflation returning to a low rate starting from 2025, it also faces downside risks amid this weakening growth backdrop.
For more on this, we're joined by Seng Wun. He's economic advisor at CGS International Singapore. We just heard that expert, your fellow expert there, saying we're facing downside risks amid a weakening growth backdrop. So what the MAS has done, an easier currency setting, is that in keeping with both inflation forecasts, inflation figures now, and growth forecast and growth in the last 2 months?
Indeed. I suppose it's really a case of you see a downgrade in the growth forecast for the year, which basically means the demand pressure may ease, especially going into the second half of the year, and therefore pressure for goods and services, especially on the services side, could cool down if we were to see a weakening in labour market condition. So yes, consistent in terms of macro forecasts on the inflation front, on the GDP growth front, labour market conditions, and therefore just the underlying fundamentals being all adjusted downwards.
All right, underlying fundamentals, I take it you're referring to not just local, regional and global as well. Of course, all the talk the last few weeks have been those tariffs from Washington. So far, any effects we've seen, certainly in the first quarter figures, that's just not immediately from tariffs as yet. If anything, it's just due to uncertainty. When tariffs actually hit, what kind of effects are we expecting to see?
Well, we have seen some of the effect immediately after the November US presidential election, in that businesses, especially in Asia, start to see front-loading of orders. And we saw a very strong end to the year with businesses which traditionally ramped up orders, see a ramp up in orders ahead of the festive New Year period, then it cooled down after the festive period, and it cooled down further, especially into Q1, because seasonally for manufacturers, exporters, there's a quiet period before the year-end demand picks up again. This time around, we saw the back orders building up consistently. But the question today now really is, will back orders still pick up? Because there is that 90-day pause where we are seeing businesses in the US say, we got that window, perhaps we should load and order some more from our Asian businesses, because we don't know what kind of tariff environment will be with us in the second half of the year. Or should we just pause for now because we have enough from the earlier orders that we have sent out? So this is the kind of uncertainty which every businesses faces now, especially those who export to the US side. And that's the kind of uncertainty which are creating I suppose, uncertainty in terms of orders, output side, and not just in Singapore, but across the region.
All right, we're hearing earlier from analysts saying that there are bright spots. One has to be proactive and one certainly has to look for them. But if it's not just Singapore, if everyone is facing these uncertainties, can anyone profit in this current environment?
Simple answer, no. Because again, if you have the two largest economies in the world, US, China, who account for 40% of global growth, it will have implications for everyone, not just tiny Singapore. Even though we were to say we trade with the rest of the world, we ramped up trade with the rest of the world, the influence and impact of US-China trade war escalating further will clearly have a knock-on impact on domestic demand in the respective countries and the rest of the world markets. And of course, if that happens, it will also indirectly influence Singapore growth, which after all is almost entirely driven by trade in demand for goods and services from overseas customers.
All right, we've heard warnings, not just from yourself, but Singapore's Prime Minister as well, potentially a technical recession this year. And of course, a technical recession is essentially just two quarters of negative growth. But in fact, quarter on quarter, we're already looking at some contraction into the first quarter of this year. So I think it's down 0.8%. What's your projection for a potential recession this year? When and how? How much?
Good question. A lot really depends now on business and consumer confidence. If the uncertainty which surround the flip-flop President Trump tariff-driven economic policy continues, then clearly we may see further pullback in orders, and that clearly will mean for businesses, either on the manufacturing side or services producer side, contraction to persist into the second half and into the second half of the year. And this is where we may see the growth coming in at the lower end of that new range forecast of 0 to 2%. So clearly boils down to whether we see a further deterioration in business and consumer confidence in the rest of the world, especially in China or in the US.
A final question then, Mr. Song. MAS, second time this year, easing its currency setting. Suggestions that it might reduce its appreciation rate to 0. The last time it did that was March 2020. Of course, that was the COVID-19 pandemic. What's your projection for the MAS? Final question.
Well, we have seen the further down. We have seen the latest downgrade in growth and inflation forecast. Much now depends on what happens in the next few months or the next 2 or 3 months, because there is room for the MAS to tweak its monetary policy further. Do they need to zeroize it when they meet again in July, perhaps? Or do they need to widen the policy band to accommodate much more significant market volatility? They could well do so. Very much will depend on market condition in the coming couple of months of whether consumer business confidence get further affected by market volatility due to tariff policies or other non-related tariff policies from the U.S. administration.
Mr. Seng Wun laying out for us what we need to be looking out for in the days, weeks and months ahead. He's Economic Advisor at CGS International Singapore. Thank you.